In this tutorial, I'm going to illustrate how to add a client, create a product, and generate an illustration document. Okay, your client, Travis Williams, you are preparing for your meeting with him. Travis has a flexible investment savings product and a retirement annuity. You want to ensure that his capital is invested in accordance with his needs and that he's on track to achieving his goals. He wants to retire at 65. So his date of birth is 6th of March 1965. Right, so there we go. First name Travis, surname Williams, date of birth 1965, 0306. So my plan makes automatic backups every 5 minutes, but you first need to save your client for the first time. All right, flexible investment savings product. The current value of that is 2,250,000. He's not currently making any monthly contributions. The percentage real increase is 0% because that applies to the monthly contributions. So let's go and add that. So under product management, so product management is the level at which you'll add normal products that you'll find on a platform. So here you can see retirement annuity, preservation fund, endowment, living annuity, and so on. We are looking for a flexible investment savings product. So that's normal discretionary investment. Okay, so we're going to start by looking at this right-hand panel, working our way down. Investment value 250 million. Monthly contributions is 0%, real increase is 0. You'll see that the anniversary month will always just default to the month that we're in this case April. That's fine. Transition age means the same thing as your retirement age is 65. Utilization strategy. This is about how you intend utilizing your wealth. Do you intend drawing an income, in which case it's a voluntary drawdown, or do you intend drawing everything out in cash at retirement? You can, of course, only do that with a discretionary investment. When you're dealing with the retirement annuity, that's going to be converted to a living annuity. And of course, with your living annuity, you can only draw a minimum of 2.5% and a maximum of 17.5%. All right, so we've done that, all right. Okay, so although regular real withdrawal is next, if you're working your way down the panel, always capture the fees first before you add an income, since fees have an impact on the capital duration. If you add the income first and are happy with how long the capital will last based on the income, and then add the fees, you'll need to go back to the income and change it so that the capital still lasts up until the desired age. So to illustrate that, let's say we go to regular real withdrawal. We put in 200,000. And based on an income withdrawal of 200,000, the capital is going to last more or less up until 95. So we think that's fantastic. Then we continue and we put in our financial advisor fee of 0.5%, our platform fee 0.4, our model fee of 0.1, and our asset management fee of 1. All of a sudden, that's a completely different story. Now the income is going to be lasting you up until whatever that is, approximately 82. So it always makes sense first to put in the fees and then to go back to your real withdrawal. So I've put in those fees. So initial fees, it's an existing investment, so initial fees don't apply. Regular real withdrawals, as I was saying, this can either be a rand or a percentage, and income is always added as an annual figure. So in this case, you calculate that Travis will be able to draw approximately 150,000 per year from this investment so that it lasts up until the age of 90. Okay, so yeah, regular real withdrawal, you can go through a process of trial and error to get your income lasting up until, in this case, 90. Much easier. A little calculator button over here, which allows you to solve for a number of things. In our case, we want to solve for the income based on the current provision. So the current provision is the capital that we have at the moment, 2,250,000. That's of course still going to grow for a few years up until retirement. So we want to know what income can we get if we're happy for it to end at the age of 90. So I can go and solve that. Note now that that went from 200,000 to 152. So because of those fees, 200,000 simply wasn't possible. That's come down now to 152,000. All right, let's look at the fund selection. But before I get into that, let's first have a look at this inflation plus 7. So long-term growth asset. So it's important to understand what that means. Let's quickly read that. Right, so my plan divides an investor's capital into different categories. So that's cash, inflation plus 3, inflation plus 5, inflation plus 7, and long-term growth. So let's have a look at that quickly. So there you go to current portfolio, and we're going to go and have a look at our current category breakdown. There you can see long-term growth, inflation plus 7, inflation plus 5. In this case, we don't have inflation plus 3 in cash because we simply aren't close enough to retirement to warrant any capital going into that, into those categories. Right, factors such as the amount of capital the client has, the client's age, how many years they are before retirement, and the client's income requirement influence the allocation. My plan allocates the portion of capital that is only going to be spent after 10 years into the long-term growth category. So to illustrate that, let's pretend that the transition age is not 65, but 75. Everything is going to be going into the long-term growth category. Again, it doesn't make sense to be sitting in cash or in inflation plus 3 because there is more than sufficient time to ride out any short-term volatility. Right, so therefore, the longer the capital will last, the more capital will be allocated to the long-term growth category. Right, you have a choice to select higher risk funds by changing the long-term growth asset to equity, or you can keep the long-term growth asset on the default of inflation plus 7, in which case you can simply select the same funds that you have selected. All right, so let's actually also have a look at this the other way around. So at the moment, this is the allocation, and that's based on the fact that he is currently 58 and will be retiring at 65. So let's pretend he's not going to be retiring at 65, but that's going to actually be happening at 60. So what do we know here? He's going to start needing an income 5 years earlier than what was initially planned. So we need to start making provision for that. So you're going to start seeing how we're going to introduce the inflation plus 3 category. So as soon as I tab out of that, you'll see there, right? Inflation plus 3 now is starting to come. There we've got the 205,000 or 9% going into that category. If we bring that younger by 1 age, 59, there you can see, in fact, that we've got the cash category, which has come into play. Right, the reason behind that, obviously, we need to draw an income. An income must be drawn from a portion of the capital where there's very low volatility. In fact, I want to quickly open up this document over here. There we go. Right, so this was one of the slides from a presentation that Matthew Lester did for the FPI back in 2016, where he was illustrating how capital should be divided into different sub-portfolios based on the investment time horizon. So you're going to allocate a portion into cash, and that's where you're going to be drawing your income from. Sub-portfolio number 2 is capital that you're going to start needing in 3 to 5 years' time. Portfolio 2, 5 to 15 years' time, and so on. And this, in fact, is very much along the lines of paper that was written by members of the FPI and FIA, where they also illustrated how capital should be divided into these different categories based on the investment term. So money that Travis needs now within the next 12 months to 2 years, we're going to put that into a cash category. Right there, you got money market funds, also some income funds. Money that he's going to need in 3 to 5 years' time, you're going to go there for your CISA low equity category, multi-asset medium equity category, and so on. So the MyPlan software is very much in line with what is recommended by the FPI. Right, so there you can see the closer you are towards needing an income, the more money is going to be allocated into conservative categories. The further away you are to requiring an income, the more money can be going into a long-term growth category. So let's change this back to 65. So I've gone off on a bit of a tangent there. What I wanted to discuss was this long-term growth asset. So long-term growth asset is that portion of the capital which is only going to be spent after 10 years. Now, you can either leave that on inflation plus 7, right, which implies that you're going to be selecting from funds which is in the ASISA high equity space, so your typical balanced funds. So in here, you're going to find Allan Gray Balance, you're going to find Coronation Balanced Plus, 91 Managed, and so on. So it's your Regulation 28 funds. When you're dealing with a product where Regulation 28 isn't of concern, as is the case here with a flexible investment saving product, you can change that long-term growth asset to equity. Now that's just the name of the category. It doesn't mean that there's only equity funds in there. There are simply a range of funds which don't comply with Regulation 28. So here's our flexible growth model portfolio, our global flexible growth model. There's a range of equity funds. There will be property funds in here. So everything that, generally speaking, won't be Regulation 28 compliant, you will find in the long-term growth category when the long-term growth asset is on equity. So there an advisor has a choice. Some advisors say, no, I like keeping the long-term growth asset on inflation plus 7 because my client is relatively conservative in nature. They don't want a large portion of their money going into equity funds. Or a particular client might say, right, I want to put the majority of my capital offshore, in which case you're going to use the long-term growth category on equity and then select some global funds, property funds, whatever the case may be. For this example, I'm going to keep the long-term growth asset on inflation plus 7. Okay, so here's your selection of funds. You've got your cash category, inflation plus 3, inflation plus 5, and so on. So under select assets, you can go and blend, and you'll see that there's a whole range of funds from which to select from, appropriate funds per category. So in this first example, for my cash category, I want 50% in the MyPlan Enhanced Income Fund and 50% in the Allan Gray Money Market Fund. So we can go 50% in there and 50% in there. Much easier than doing this every single time for each client. You can create a fund template. So you might like particular funds and model portfolios in each of the different categories. So let's just go back here for a second. So in the inflation plus 3 category, I've got the inflation plus 2 to 3 model portfolio at 70%, and then the coronation balanced defensive at 30%. In the inflation plus 5% category, I like the low cost balanced model, inflation plus 7. I've got the inflation plus 6 to 7 model portfolio, 91 opportunity. So you could go and do that every single time, or you can save fund selections as a template. So I can go and save template, and then for future plans I can go and apply a template. So there I've got Travis Williams, and it will then automatically go and apply the selection which I've previously created and saved. Then you can come here, right click, generate your illustration document, English or Afrikaans. Tick on that box. And yeah, you've got your okay, so this is called an illustration report, not an investment report, because you might still want to be showing your client a number of different scenarios. What happens if we retire at 67 rather than 65? What if you increase your contributions from 5,000 to 7,000? Whatever the case may be, you might want to be creating a number of different illustrations. And while I think about that, let's go and create a copy. Over here, we might choose to change the transition age to 67. And here you can right click and you can rename this, and you can say retire at 67, or whatever the case may be. So you can create a number of different scenarios without having to create new plans every single time. You can then create reports for your client, rename them to illustrate different scenarios. That's why it's still called an illustration report. Once you're happy with everything, you then can convert this into an investment and actually then apply it. I've got the My Plan logo at the top here. You can come here to registers and templates, report image, and add your own logo. Okay, so let's have a quick look through this. Okay, so this document is your proposal document. It's what you're going to be discussing with your client, and at the same time it's going to be your record of advice, in the sense that it's going to disclose everything that you as the planner need to be discussing with your client when providing advice on particular products. So in this case, we are dealing with a flexible investment savings plan. So it's going to give an introduction about what that is, risks that need to be managed and understood. So it's going to combine everything that you really need when discussing this with your client. There you can see the illustration of how the capital is divided into the different categories based on the investment term and then the return objective. There's your initial capital, 2,250,000. There aren't any initial fees. There aren't any contributions. There's my annual fees. Let's just scroll down to this graph. So there you can see the graph. Client currently has 2,250,000. There you can see how it's going to continue growing up until the age of 65, after which it's going to start decreasing. These blue bars at the bottom here, that's the annual income. The different shades in the graph itself represent the different funds and or model portfolios that you have selected. One thing I didn't discuss was the nominal illustration. So if I scroll down a bit further here, you can put in your inflation assumption. Let's say 6%, or you can click on this blue arrow and it'll pull through whatever the latest inflation figure is. So this is a real illustration, implying you're looking at it in today's terms. And after you've put in an inflation assumption, you can look at it in nominal terms, look at it in future terms, including the impact of inflation. So there you now can clearly see how that capital is going to be growing and how the income will also be growing. Here is your cash flow table. So there's your capital. Income starts at the age of 66. There you can see how the capital gradually, again, we're looking at this in real terms. In nominal terms, this capital is probably still growing. In real terms, it's gradually decreasing. And then we can see that it is depleted at the age of 90. So we're happy with that. There you can see the allocation, how that's been allocated to the different model portfolios, different funds, and so on. There's your asset allocation. In each of the underlying categories, what you've chosen. So in the cash category, we selected 50% in the MyPlan Enhanced Income Fund, 50% in the Allan Gray Money Market Fund. We also selected a portion in the Inflation Plus 3 category, the model there that's illustrating what the underlying funds are. So 91 cautious managed, some Inflation Plus. For the Inflation Plus 5 category, we selected the low-cost model portfolio. For the Inflation Plus 7 category, we selected a portion in the Inflation Plus 6 to 7 model portfolio and a portion in the 91 managed fund. All right, I think I'm going to leave this tutorial as is at this point in time. In a future one, we'll then load the retirement annuity. I'll illustrate how you can combine that into one product, so you can illustrate to the client what his entire investment portfolio looks like. That's going to give an indication as well in terms of what income is taxable, what income is not taxable, and so on.